You've probably heard that old saying a million times, don't put all your eggs in one basket, right? It's classic advice for a reason. Because if you drop that basket, well, you lose everything. And you know what? In the world of investing, that simple idea is one of the most powerful strategies there is for building wealth, and maybe more importantly, for protecting it.
So let me ask you straight up. Think about your savings, your investments, everything. Is your entire financial future riding on the success of just one company, or one industry, or even just one type of asset? Because if it is, you're taking on a massive and frankly totally avoidable risk. That risk actually has a name. It's called concentration risk. And it's what happens when way too much of your money is tied up in just one or two things. Like someone who has their entire net worth in their company's stock, or who poured every last dime into a single cryptocurrency. If that one thing goes south, the results can be absolutely devastating. Diversification, that's your shield against this. Okay, let's get into the good stuff. Because most people think diversification just means, oh, I'll just own a bunch of different stocks. But that's not the whole story, not even close. The real secret, the actual magic that makes diversification work, all comes down to a concept called correlation. So what on earth is correlation? Well, it's actually pretty simple. It's just a way of measuring how two different investments move in relation to each other. Do they both go up and down at the same time? Or does one zig while the other one zags? See, the goal isn't just to own a lot of stuff. It's to own stuff that behaves differently when the market gets crazy. Let's make this crystal clear. On one side, you've got high correlation. Think about owning shares in, say, two different big tech companies. I mean, they're different companies, sure, but if the whole tech sector takes a nosedive, they're probably both going down together. But on the other side, you have low or even negative correlation. Stocks and high-quality government bonds are the classic example here. When things get scary and people sell stocks, they often run to the safety of bonds, which can push bond prices up. That right there, that's the balance we're looking for. And hey, you don't have to take my word for it. The financial historian Peter Bernstein absolutely nailed it with this quote. Owning just a handful of things that react differently to the market is so much more powerful than owning 100 things that all sink or swim at the same time. It's about the quality of your diversification, not just the quantity. So the big question is, how do you actually do this? How do you build this kind of portfolio? Well, let's open up the toolkit. There are a few really clear and effective ways you can spread your risk. Here are the 4 main levers you can pull. First, you can diversify by asset class. These are the big buckets, like stocks, bonds, real estate. Then by sector. So if the tech industry has a rough year, maybe healthcare is doing great. Next up, geography. Because if the US market is down, markets in Europe or Asia could be soaring. And finally, you can diversify by company size, mixing those giant, stable companies with smaller, high-growth ones. Now, for most of us, diversifying by asset class is the single most important place to start. It's the most powerful lever. This chart gives you the main players. You've got stocks for growth, bonds for stability, maybe some real estate or commodities as alternatives, and then cash for safety. Each of these plays a different role on the team, and they all react differently to things like inflation or interest rates, giving you that essential balance. All right, we've covered the why and the what. So now for the fun part. Let's actually put all of this together and see what a simple, well-diversified portfolio looks like in the real world. But wait, before you start thinking, oh man, I don't have time to go buy hundreds of individual stocks and bonds, let me stop you right there. For most people, there's a much easier way. Exchange-traded funds, or ETFs, and mutual funds. Seriously, you can buy a single share of one of these funds and instantly own a tiny piece of hundreds or even thousands of different companies. It's literally diversification in a box. Okay, check this out. Here's a classic, super easy to understand portfolio. It's split into 4 equal parts. You've got 25% in stocks, that's your growth engine. Then 25% in bonds. Think of these as the shock absorbers for when stocks get bumpy. You have 25% in cash, which gives you safety and the ability to jump on opportunities. And finally, 25% in something like gold, which often acts as a safeguard when there's a big crisis or high inflation. So building a portfolio like that is a fantastic first step. But, and this is a big but, here's something a lot of people miss. A diversified portfolio needs a little bit of maintenance. It is absolutely not a set it and forget it kind of deal. And let me show you why. The problem is a sneaky little thing called portfolio drift. As the markets do their thing, going up and down, the value of your assets changes.
And the parts of your portfolio that do really well will naturally become a bigger slice of the pie. And without you even noticing, this can throw your whole strategy out of balance and bring back all that risk you were trying to get rid of.
Let's look at a quick example. So, you start the year with a nice, moderate, balanced portfolio, 60% in stocks, 40% in bonds. Perfect. This matches exactly how much risk you're comfortable with. But then, boom, the stock market has an incredible year. Your stocks grow way, way faster than your bonds. So by the end of the year, look what's happened. Your portfolio has drifted all the way to 75% stocks. And just like that, without you doing a single thing, your once balanced portfolio is now way more aggressive and way riskier than you ever intended it to be. So what's the solution? It's a process called rebalancing. And this is just the disciplined act of, every so often, selling a little bit of your winners, the stuff that's grown a lot, and using that money to buy more of the stuff that's lagging behind. What it really does is it forces you, automatically, to sell high and buy low, which keeps your portfolio right where you want it to be. So, to wrap this all up, here is a simple, 4-step checklist to take with you. 1. Define your goals and figure out how much risk you're actually comfortable with. 2. Based on that, choose your target mix of assets. 3. Make your life easy. Use low-cost funds like ETFs to get diversified instantly. And 4. The crucial final step. Don't forget to check in at least once a year to rebalance and make sure you're still on track. So I'll just leave you with this one final thought to chew on. The real point of diversification isn't just about chasing the highest possible returns. It's about building a resilient portfolio, one that can survive the inevitable storms the market will throw at it. So ask yourself, is your portfolio built just to grow, or is it built to last?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.